Camilla Jeffs with Steady Stream Investments, and today we're talking about the difference between active and passive investing. Which one's right for you? Did you know that you could invest in real estate without the headaches of tenants, toilets, and termites? It's true. You can get all the benefits of investing in real estate without any of the hassles of being a landlord. Now, when most people think of real estate investing, they think of rental property investing, right? Buy a single family home, find a renter, and collect that rental income. Sounds easy enough, but the reality is quite different. I mean, even with a professional property management team on board, you as the landlord still have an active role in the investment. So the property managers, they may take care of the day-to-day issues, but you still need to be involved in strategic decisions like whether to evict tenants who aren't paying, filing insurance claims when unexpected surprises happen, and sometimes have to put in additional funds to cover maintenance and repair costs. Now, on the flip side, you have passive investing, which are the set it and forget it type of real estate investments. You invest your money and someone else does all the heavy lifting. The great part about passive investing is that it's totally passive. You don't get any calls from the property manager. You don't have to screen any tenants. You don't have to file any insurance paperwork. However, being a passive investor also means that you have to relinquish some of your control in the investment and trust someone else, like the sponsor team, to manage the property and execute the business plan on your behalf. So the big question, should you be an active or passive real estate investor? Okay, so I have 10 things you need to think about to decide if that path is right for you. Number 1, tenants, termites, and toilets. So if you've dreamt of becoming a landlord, having tenants, making improvements, then yeah, do it. Consider an active investor role. Otherwise, if tenants, termites, and toilets makes you nauseous, you should go the passive route. Number 2, time. Now, active real estate investments require a lot more time, especially during the initial acquisition, then throughout the project lifestyle, while passive investments, they only require some time up front during the research phase. Number 3, involvement. So how hands-on do you really want to be? Do you want to manage the property yourself? Do you want to get the tenant requests? Do you want to schedule the maintenance appointments? Or do you want to sit back and let someone else do all of that? Number 4, profits. With active investing, so you would likely be the only owner of the property, so you get to keep 100% of the net profits, right? With passive investing, profits are distributed a lot among many investors. Now, that doesn't necessarily mean one type of investment will net you higher returns than the other. You'll have to compare the deals. All right, number 5, expenses. So active real estate investors have to plan to handle the emergency claims, the insurance, repairs, anything that could require additional money at times, where passive investors, they only make an initial capital investment. Number 6, risk and liability. So with active investing, if things go south, you are personally held liable, which means you might not just lose the property, but your other assets as well. In passive investing, liability is limited to the capital that you invest because typically we hold things in an LLC. So if something goes wrong, it's the sponsors who are liable, not the passive investors. Number 7, paperwork. Active investments are paperwork heavy, from the initial purchase of the property to tracking the purchase, the rental agreements, the bookkeeping, legal documents throughout the project. But with passive real estate investments, on the other hand, you typically sign one document, right? A single PPM or private placement memorandum to invest in the property. No need to fill out lender paperwork or file insurance or do any bookkeeping. Number 8, your team. As an active real estate investor, you have to build your own team. So you need brokers, you need property managers, you're going to need contractors and maintenance people. But as a passive investor, you rely on the shared expertise of the existing sponsor team. So they already know the market, they already have a team and set up to manage the property. Number 9, diversification. So with active investing, you yourself have to be an expert in the market and asset class that you're investing in. If you're investing outside your local area, you have to research the market. You might need to find a boots on the ground team and visit the area. With passive investing, it's quite easy to diversify across different markets because you don't have to start from scratch with each market. You're investing with teams that have already taken the time to research those markets and build strong local teams. Finally, 10, taxes. As an active investor, you're responsible for bookkeeping, meaning you have to keep track of the income and expenses. You'll also have to work with their CPA to make sure you're properly depreciating the value of the asset each year. As a passive real estate investor, you don't need to do any bookkeeping. You receive a Schedule K-1 every spring for your taxes, which shows the income and losses for that property. So no need to track income and expenses throughout the year. Now, if you're ready to roll up your sleeves and get involved in the aspects of being a landlord, then active investing just might be the perfect adventure for you. However, if your time is limited, but you have capital to invest, you may want to consider being a passive investor. And if you're hoping for some kind of middle ground option, sometimes turnkey rentals and buy and holds, they could provide some control without the huge time investment. Now, when you're trying to figure out which path is right for you, be sure to factor in your unique situation. What are your goals and what are your interests? Thanks for joining. Please remember to like, subscribe, and share. After all, this is group investing. Bye for now.